buy all 100 shares instantaneously of the FTSE 100 for about £6.50.
And can you explain these so-called fundamental ETFs?
Yeah, it comes down to a basic argument that started really in academia about an idea that if you look at a share price, for example, does that share price represent all, can you look and see if there are biases from past information, current information, or even future information? And you have a group of academics who really believe that the share price reflects all information, that it is the most efficient measure of really all information that we have. But there's a real difference. A lot of people said, well, look, we live in a real world. And we think that price is particularly shorter term because people have fear, they have greed, different behavioral emotions. Sometimes that price deviates from what the real value of that company is, particularly in the short to medium term. So it's more of a philosophical shift, but what we've done is we've taken that theory into practice. And we said if you do believe that, particularly because investors' behavior varies short to medium term, how can we then go to look at the intrinsic value of shares or indices overall and build a product around that? So what we've done is we've partnered with the leader in this space, Research Affiliates and the FTSE group here in London, and we've created a series of indexes on the US, Europe, and Japan. And again, the idea is that rather than looking at the current price reflecting the perfect value, if you will, we believe that by weighting cash flows, the dividends, the revenues, and the price to book value of the constituents of the indices, that's going to lead you to a long-term a better performance and really reaching the true intrinsic value of the company. So it's a bit long-winded, but it's an interesting concept, and if you will, the testing of past performance in the U.S. has led to superior returns on a risk-adjusted basis. And in particular in the U.S. market, we've seen risk-adjusted returns from 1962 about 2% higher than the actual S&P 500 at slightly lower volatility. So it's new. Let's see how these trade through various market cycles, but I think it's an exciting development. And I think that using traditional indices, which are tried and tested, it probably makes the most sense. But I think looking at some of these fundamental indices, they're certainly going to find a place for the right investors.
So let's look ahead. What trends do you see overseas in ETFs that might come here to the UK?
Well, as you can see, we've pretty much covered all the traditional asset classes. We're now covering almost all of the alternative asset classes. But I think what investors are asking for are some of the tools that you may have associated with, say, even hedge funds in the past. Look, I'd like the ability to short more efficiently. I'd like the ability to perhaps use leverage more efficiently in my portfolio. And again, for most investors, we, as a provider, we recommend talk to your advisor, your financial planner. But for more sophisticated clients, particularly in the UK, they're looking for those opportunities. So, for instance, in the US, there are a few ETFs that are used for shorting called inverse ETFs, and they'll literally give the inverse performance of a traditional index. Well, we certainly see, hopefully sometime this year, a number of those ETFs coming to the UK and Europe. I think that's a great trend. As well, we're seeing some clients who would like to actually have leverage inside of an ETF. So rather than, if I want to buy, say, the FTSE 100, I'd like to have 2 times the upside, understanding that I'm going to also have 2 times the downside. So it's these nuances that investors could somehow do themselves, but perhaps we can do it more efficiently within an ETF wrapper.
So we've learned about how ETFs work, examined the range of underlyings, and considered some of the benefits. It's time for the Stock Talk Insight.
The beauty of ETFs is that they can be used to build a balanced portfolio. They enable investors to allocate assets and gain exposure to asset classes, indices, geographical areas, commodities, using ETCs as well as traditional ETFs and fundamental styles. Any long-term investor with an idea of the portfolio balance they want to achieve can use ETFs to excellent effect. And since ETF dispense with fund managers and research teams, their costs are lower, meaning that more of your savings stay in the fund. This type of portfolio lends itself to tax-efficient accounts such as ISAs and self-invested personal pensions. Some investors find market timing troublesome, or indeed the nature of their available funds means little and often rather than lump sums. Drip feeding cash into the market can make sense. It allows you to take advantage of pound cost averaging. That is, by investing a similar amount each month, you will inevitably buy at market peaks. but you will also buy when the market dips, and at these low points you will purchase disproportionately more units. ETFs lend themselves to regular investment. They are diversified and collectively offer access to world markets and sectors. Over the long term, you will be able to build up profitable positions, creating a diversified portfolio. A different kind of investor might monitor world markets and sectors, seeking opportunities to take advantage of volatility in stocks, sectors, bonds or commodities. ETFs present possibly the most accessible and cost-effective method of gaining diversified exposure, and because designated market makers offer real-time two-way prices, spreads are tight and liquidity maintained, so selling should be just as easy.
Well, that's it from this edition of Stock Talk. I hope you found it useful. If you'd like more information about exchange-traded funds, call our customer services helpline. We'll be happy to help. And if there's any topics you'd like covered by the programme, email me at the address on the screen. Thank you for watching.